Are you still looking for the best values in Europe? And if so, why? Because Europe is set, its economy is set to contract again early this year, could enter a double-dip recession, has had to go into pretty extreme lockdown measures. Why invest there now?
Well, it's some of these various macro factors that actually provide investment opportunity. What we're seeing in terms of economic conditions should be somewhat transitory and short-term, and they're enabling us to buy companies kind of based on the fear that's in the market, buy these companies at extremely low and discounted prices. At some point, Europe will bounce back quite strongly. You see what's happening in the UK. The Brexit situation is behind them. A lot of these big picture items that were kind of winds in the face of the geopolitical situation as it pertained to Europe are now behind us. And I think once we get through these pandemic spikes, these virus spikes, especially in places like the UK, you will see economies that have substantial pent-up demand as a result of some of these geopolitical European political issues. You'll see these economies take off. And meanwhile, the stocks are priced to complete imperfection, thereby providing us with the opportunity to buy some really good businesses at very low prices.
You've liked the European banks for a long time, David. Is that still the best place to be, even with the continued promise of stimulus, quantitative easing, zero interest rates, everything else that the ECB is going to have to do to get this recovery going?
Yeah, I think, we have been well invested in these things. Certainly in 2019, they helped us. 2018, they hurt us. 2020 did not help much. But now we see these financial institutions are in a very strong position to rebound. Why do I say that? Over the last decade, they've built trillions and trillions of capital on their balance sheets, thereby putting them at or above their regulatory requirements. This was capital that normally could have been used to extend credit or to pay back owners. And now we're in a position where these financial institutions are in a position of excess capital where they can start growing their businesses and they can start making bigger distributions to owners. Number two is that I do believe we will see a rebound in the European economy. And again, some of the factors I mentioned earlier about the political dynamic, a lot of these things are now in the rearview mirror. The pandemic, hopefully, by the time we get to the second quarter, will be in the rearview mirror. So we should see relatively strong growth pickup. And number three, like the United States, we're going to see pressure on interest rates with all this borrowing and all this growth picking up and all the stimulus added. I do believe that you will start to see slowly pressure on interest rates also being a very positive dynamic. Meanwhile, when you compare what's happening, what I just said, with the prices, many of these companies are still just at 50, 60, 65% of book value, and they should be able to earn well over 10% return on equity. It's normality, meaning that you should have significant upside in these businesses. So after a decade of capital build and slow growth, I think the factors that have hurt this sector in the past are now finally switching from headwinds to tailwinds.
Shepard Smith here. Thanks for watching CNBC on YouTube.